Reaction this morning, please.
So now we understand why Chair Powell wanted to separate the SLR decision from the monetary policy decision, because they could have been viewed as contradictory. I don't think they are, but I listened carefully to what Priya said. John, I think the bigger issue here is that the economic paradigm is changing, and the Fed doesn't want to change too much the policy paradigm. So while this is a change, it's such a small change, the bigger issues remain. And the reason why is because it doesn't want to disrupt the liquidity paradigm. So when we look forward, whether it's end of quarter or beyond, the question is, how do you reconcile the economic paradigm changes with policy and liquidity? And that's what the market is trying to figure out right now.
Mohamed, when you refer to the liquidity paradigm, can you tell us in more detail what you are referring to and the reason you're so concerned about it at the moment?
It's what you said earlier today when you were on with Tom, which is, have you noticed that good news for the economy has turned out to be bad news for the markets? And it's a complete reverse of last year. And what reconciles all this is that bad news for the economy meant ample and predictable liquidity injections by central banks around the world. Now we're seeing increased dispersion among central banks around the world. And that is undermining what has been a very comforting liquidity paradigm. So that's why you've noticed, and others have noticed, that good economic news has become bad news for markets. And the transmission mechanism is the liquidity paradigm. There's less confidence in the robustness of a liquidity paradigm that has been incredibly helpful for assets.
Just how cornered are central banks right now, Mohamed? We've seen the move from Brazil, Turkey this week, Russia, maybe more to come from the Russian central bank, and a Fed just willing to stay on hold, even with the numbers they're forecasting into 2023, a Fed that is willing just to look through it, sit tight, and not do anything with interest rates.
Yeah, I mean, it's going to be harder to sustain. They're not going to be able to sustain that position. I think that even at 6.5%, they are still not incorporating fully the bounce we're going to get in this economy as long as we don't mess up with the COVID battle. So I'm looking at 7% plus for growth this year. It is an open question whether inflation will indeed be transitory, but I understand why they are hesitant to change their forward guidance. So I think they're going to be at some point find themselves in an even tougher corner. And the hope we all have, John, and it's a really important hope, is that we get a second pro-recovery fiscal package that allows for that handoff that we've been waiting for such a long time from excessive reliance on unconventional monetary policies.
In the meantime, we've had to deal with a lot of volatility in this bond market, a big drawdown in Treasuries, a big surge in Treasury yields. Mohamed, you've seen Treasury sell-offs a million times over several decades, and we've got the benefit of leaning on your experience right now. How unique has this sell-off been? How unique is this moment for you?
So, John, what's encouraging about this moment is that it hasn't broken anything. If I had told you at the beginning of the year that we're going to get a 70 basis points move within the first 2+ months of the year, we would have had a discussion about that's going to catch people off sides. Well, it turned out that very few people got caught off sides. And that I think is reassuring in terms of the functioning of the market. Having said that, there were 2 episodes of illiquidity in the midst of liquidity. And that's one thing that concerns me. But it is unique because of the overall environment. But thank God, it's not unique in terms of creating breakage in markets.
Well, I know you've been more concerned about financial stability than you have inflation, when others have been focused on that. You said nothing's broken. Mohamed, I just wonder whether we're starting to see cracks leading to something breaking in emerging markets. I'll spend a bit more time talking about that through the programme. What's your response been to what's been happening, developing in EM, and what's the team at Gramercy got to say about it?
So I can't speak on behalf of the team of Gramercy. Robert would be much better placed. But the message, I think, that is consistent with what they're thinking is the following, is that it's very hard to make a case for EM in general. But you can make a case for being long or short different names. EM is very diverse right now, and you can no longer rely on liquidity just going there. It is going to be a very selective year for emerging markets, and it will be for risk assets as well. Look at what's happened so far this year. As of yesterday, banks were outpacing the NASDAQ by 30 percentage points. So the market is starting to figure out that the liquidity paradigm, if it reverses, will hurt certain segments more than others. And I think the market is seeing its way through it, but it's going to be a very differentiated marketplace.